Welcome to The Explainer. I'm absolutely thrilled to have all of you portfolio managers joining us today. Look, our goal for this briefing is straightforward. We're going to take the very latest market pulse and distill it into a sharp, tactical roadmap for June 2026. Right now, we're looking at an environment that is flashing some incredibly fascinating signals. We've got this balancing act between remarkable economic resilience and some, well, very distinct undercurrents of volatility. If you're actively managing risk and hunting for yield right now, you absolutely need to understand exactly what these crosscurrents mean for your strategies. To get us there, we're going to cover a few key areas today. First, the macro and rate dilemma. Then, we'll look at tech versus defensive rotation. After that, valuations and historical averages, followed by geopolitics and safe havens. And finally, navigating upcoming summer volatility. Section 1. The macro and rate dilemma. Okay, so we are stepping right into the middle of a high-stakes macroeconomic tug-of-war. On one side, you have undeniably strong U.S. employment data. It proves the economic engine is still humming along beautifully. But for your portfolio positioning, that exact same strength completely kills the urgency for the Federal Reserve to cut interest rates. Investors are rapidly having to price in this higher-for-longer reality, and you know that directly pressures borrowing costs and valuation multiples across the board. Now, despite that massive rate dilemma pulling the S&P 500 back from its absolute record highs to around the 7,520 mark, the index is still up roughly 11% year-to-date. Just think about that for a second. Even with the harsh realization that the Fed isn't coming to the rescue with immediate rate cuts, the broader market has demonstrated staggering resilience. It's continuing to trade near historic highs, which really tells us that underlying corporate fundamentals are, at least for now, bearing the heavy weight of these higher yields. Section 2. Tech concentration versus defensive rotation. But beneath that surface-level 11% gain, this macro tension is actively fracturing different sectors of the market. Take a look at the Dow Jones Industrial Average, finishing up near the 51,500 level. It's showing incredible relative resilience, as capital naturally seeks safety in those predictable blue-chip earnings. Conversely, though, the Nasdaq Composite is experiencing the largest declines among the major indexes. Those high-flying AI and semiconductor stocks are taking a pretty sudden, sharp hit. And the specific catalyst for this tech pullback? It wasn't just abstract fear, it was concrete data. Disappointing guidance from Broadcom acted as the spark that really ignited a wave of selling across the semiconductor space. When a massive player like Broadcom signals a slowdown, or even just tempers expectations slightly, it immediately forces the market to look in the mirror and ask, wait, are the astronomical valuations across the entire AI ecosystem actually justified? So the absolutely crucial point here is this. Market leadership has become dangerously concentrated in AI and technology. As our source report points out, when the market gets this top-heavy, tracking sector breadth isn't just a good idea, it's absolutely vital for your portfolio risk management. If that handful of tech giants falters, especially as growth stocks face those headwinds from shifting rate expectations we just talked about, the broader market becomes highly vulnerable. That is, unless defensive sectors can step up and fully shoulder the load. Section 3. Valuations and historical averages. To really grasp the vulnerability of this tech-heavy concentration, let's zoom out a bit. Let's look at some macro valuation metrics, establishing our baseline with the famous Buffett Indicator. As a quick refresher, comparing total U.S. stock market capitalization to the GDP lets us clearly see if the stock market is growing completely out of proportion with the actual real-world underlying economy. And right now, the answer is a resounding yes. Current estimates place that ratio between 200 and 220%. I mean, these levels are so elevated above long-term historical averages, they practically need supplemental oxygen. We are looking at a historically stretched market capitalization relative to our actual economic output. Now, obviously, a high Buffett indicator doesn't guarantee a crash is happening tomorrow, but as this quote from our source material perfectly captures, future returns may become more dependent on earnings growth and economic performance. What this really means for you as portfolio managers is that the margin of error is completely gone. Poof. Companies can no longer rely on multiple expansion to just automatically drive their stock prices higher. They actually have to deliver these spectacular earnings that these 200+% valuations are pricing in. Section 4. Geopolitics and safe havens. With equities basically priced for perfection right now, let's pivot to actionable hedging behaviors. Let's look at how the highly unpredictable global landscape is actively driving capital around the world. Geopolitical developments remain a massive, immediate market driver for the second half of 2026. We're tracking ongoing and severe tensions involving Iran, Israel, and Lebanon. And guys, this isn't just political noise. This directly impacts risk sentiment and actively supports energy prices because of the persistent threat to major oil supply routes. Add to this the fact that global central banks are walking an incredibly precarious tightrope, trying to balance sticky inflation against emerging slowing growth trends, and you basically have a textbook recipe for significant macro instability. And the market is already organically hedging against that instability. Just look at the safe haven flows. Gold is holding strong, elevated well above recent historical ranges. Silver is actually one of the top performing commodities of the year, trading near multi-year highs. That's thanks to a combination of heavy industrial demand and intense precious metals investment flows. Meanwhile, the US dollar index, the DXY, is strengthening in the wake of that hot jobs report. As portfolio managers, you know exactly what that means. A strengthening dollar creates massive pressure on emerging market assets and commodities, which complicates the global trade picture even further. So, considering all of that, it's really no surprise that the VIX, Wall Street's classic fear gauge, is finally moving higher off its recent lows. Now, to be fair, the broader fear and greed index still leans toward optimism, meaning we aren't in a state of full-blown panic yet. But this rising VIX is proof positive that investors are digesting these higher yields and geopolitical risks. They are stripping away the spring euphoria and becoming vastly more cautious and selective about where they deploy their capital.
Section 5. Upcoming Summer Volatility.
So let's translate all of this into an immediate forward-looking roadmap. This is the multi-million-dollar question for everyone watching today. How do you actively navigate these larger expected swings over the coming months? With valuations this stretched, breath narrowing, and geopolitics simmering, summer 2026 is shaping up to be a highly volatile ride. Your tactical watch list for the immediate week ahead is absolutely packed. First, keep a laser focus on the upcoming U.S. inflation data and CPI prints. They are going to instantly dictate the next move in Treasury yields. Second, you've got to parse every single word of Federal Reserve commentary for any shifts in that higher for longer narrative. Third, we need to see if major technology earnings can actually justify those stretched AI multiples following Broadcom's recent warning. And finally, keep a very close eye on the liquidity sponge that is the historic SpaceX IPO. It's one of the largest public offerings in recent memory, and its market reception is going to be a massive bellwether for broader risk appetite. To wrap up our explainer today, the overarching market tone right now remains neutral to cautiously bullish. The economic data is undeniably strong, and indexes are sitting near records. But beneath the surface, the fragility is very real. Between historically elevated Buffett Indicator levels, intense tech concentration, and unpredictable global conflicts, the complacency we saw in the spring is officially over. So I want to leave you with this final, critical thought to chew on. As we stare down shifting Fed expectations and guaranteed summer volatility, are your portfolios truly positioned to weather the storm, or are you just riding the momentum of yesterday's AI rally? Thank you so much for exploring this with us today, and until next time, keep your strategies sharp.